Let's go. Part 2 of our 100-question extravaganza to get you through the 2025 version of the real estate examination in any state, anywhere, everywhere. Let's go. Part 2. Coming at you now. Question number 26. What is the main purpose of property disclosure requirements in real estate transactions? Letter A. To minimize a broker's liability for agent's negligence. Letter B. To provide buyers with essential information about the property's condition. Letter C. To protect sellers from all legal liability that may arise after the sale. Letter D. To protect the lender's investment in the property. And the answer is letter B, to provide buyers with essential information about the property's condition. So the prime directive of property disclosures is to inform the buyer of material facts and or any potential material defects that need to be disclosed. And that's sort of the fundamentals of what property disclosure is for. Does it help to reduce liability? Sure, it could. But at the end of the day, as you may know, in your states, depending on when you're studying this, it could be consumer protection laws that don't really absolve sellers and brokers from a lot of liability when it comes down to disclosure. But property disclosures are a way to help buyers be well informed to make sure they can make the best decisions, either move forward or not in a property acquisition. Question number 27. In a title theory state, who holds legal property ownership until the mortgage debt is fully repaid? Letter A, the borrower. Letter B, the trustee. Letter C, the remainder man. Letter D, the lender. And the answer is letter D, the lender. All right, so what you'll learn in your real estate finance sections is you'll learn a little bit about lien theory versus title theory. And you want to know the basics. You don't need to go too heavy into it, but the concept of what title theory is versus what lien theory is. And the idea of lien theory so much is that a lender can place a lien on the property and ownership of the property remains with the borrower throughout the entire course of the loan. And in title theory states, what they say is that the lender, in fact, is the titled owner. And many times what they'll do is they'll set up something called a deed of trust. And in a deed of trust, the mortgagee is also the beneficiary of this transaction to make sure that they still hold on to something until the debt has been satisfied. So you just want to know the basics of what is the difference between a title theory state and lien theory. And in this particular question, in a title theory state, the lender is going to hold on to legal property ownership until the mortgage debt has been fully paid. Question number 28. Which of the following scenarios would violate the Sherman Antitrust Act? Letter A, holding a free informational seminar for first-time homebuyers to generate leads. Letter B, collaborating with other real estate firms to divide up neighborhoods to avoid competition. Letter C, offering discounts on commission rates for repeat customers. Letter D, hosting a professional development seminar to discuss how to provide better customer service to clients. And the answer? Letter B, collaborating with other real estate firms to divide up neighborhoods to avoid competition. And what they call this is allocation of customers and marketplace. And so you want to make sure you understand the basics of what Sherman Antitrust is. And you also want to understand what the penalties are, the violations. You don't need to know the monetary penalties so much so. You might see them, you might not. But you do want to know what things like tie-in agreements and allocation of customers in marketplaces and price fixing and these types of definitions and vocab phrases to help you get through the Sherman. Without doubt, you will see some kind of question on the Sherman Antitrust Act because brokerage is subject to antitrust laws. Question number 29. Which of the following is generally not considered to be an operating expense for investment properties? Letter A, management fees. Letter B, accounting, routine maintenance, and repairs. Letter C, monthly mortgage payments. Letter D, property taxes and insurance. And the answer is letter C, mortgage payments. So monthly mortgage payments are not a part of the operating expenses inside of these transactions. So you want to know a little bit of the difference there when it comes down to it. All of this is going to be an income capitalization inside of the appraisal sections of your books, wherever you are studying this. Good luck, by the way. And what you want to look to is kind of understanding that. Without doubt, high probability, probably more so on the brokerage exam than the salesperson, but you never know. You will see some kind of reference to figuring out cap rates, if not figuring out values and utilizing cap rates and utilizing the net operating income. And you need to be able to do the basic calculations. But operating expenses are things like management fees and accounting, routine maintenance and repairs, property taxes and insurance, all of which are considered operating expenses. The monthly mortgage payments are not considered operating expenses. They are considered debt service, and they are added to the mix later because two investors, all things being equal, one could choose to finance and the other could pay all cash. So the idea is no matter what, whoever they are, cash buyer or not, financing, operating expenses are operating expenses. So we factor in debt service after, and it doesn't affect the capitalization approach when we're looking at valuation. Question number 30. What does it mean when a person dies intestate? Letter A, they have left a will specifying how their property should be distributed. Letter B, their property will be distributed according to the state laws because they did not leave a will. Letter C, their property automatically transfers to their spouse regardless of state law. Letter D, they have specified that their property should be donated to charity. And the answer is letter B, their property will be distributed according to state laws because they did not leave a will. You definitely want to know the definition of what testate is and intestate. So intestate is when somebody dies without a will. Now, you'll also learn there's another vocab phrase called escheat, which you'll learn in real estate courses, and that is when somebody dies without a will, so they die intestate, and they also died with no heirs. And then the state or the county will get the property if they don't have anybody to give it to. So you want to know some of these basic definitions? Definitely, this is a Class A way of describing intestate. It's a different way because many times you'll see it simplistically put when somebody dies without a will. But in this particular case, they gave you a scenario. Their property will be distributed according to state laws because they did not leave a will. And this is a great way to learn different vocab phrases by having them be framed out in a different light. Question number 31. Which type of property ownership is only available to married couples and has the right of survivorship? Letter A, tenancy by the entirety. Letter B, joint tenancy. Letter C, tenancy in common. Letter D, fee simple tenancy. And the answer is letter A, tenancy by the entirety. So this is a type of ownership, and it's only available to married couples, and it has something called the right of survivorship. You definitely want to know what that means. Basically, what right of survivorship means is that the surviving spouse gets 100% of the asset, because tenancy by the entirety basically means that the spouses now own this thing as like sort of one entity. The spouses become one, and entirety means one, and they get the right of survivorship, which means they own 100% of the asset together. And if one of them were to pass, well, then the other surviving spouse gets the ownership. So right of survivorship means the surviving partner gets the interest in that property. So that's what they reserve tenancy by the entirety for many times, because they want to make sure that couples, number one, if there's common individual credit debts and things of that nature, that the property, the home, might be kept separate from those things. And then it also is a good, clean way to title things, because many times consumers have the biggest asset that they typically own is the home, their primary residence, and they want to make sure that there's no probate issues or any other conveyancing issues when it comes down to death and property transfers. You want to know the definitions of all of these. Tenancy by the entirety, joint tenancy, tenancy in common, and then fee simple tenancy you can leave out. Fee simple simply is the highest form of ownership interest recognized by state law. The other one would be community property, which in certain states you guys do observe community property, in other states they don't. Question number 32. Which of the following statements regarding the capital gains tax exclusion on a primary residence is true? Letter A, a single homeowner can exclude up to $250,000 of profit. Letter B, a married couple can exclude up to $500,000 of profit. Letter C, a married couple can exclude all profit if they have lived in the home for 2 or more years. Letter D, both A and B. And the answer, letter D, both A and B. So, number 1, a single homeowner can exclude up to $250,000 of gain. And letter B, a married couple can exclude up to $500,000 of profit. Letter C, a married couple can exclude all profit, if they have lived in the home for 2 or more years. That is not true. And as of the filming of this particular question, then this exclusion is still in effect. And again, you want to make sure things could change. They could change the exclusions. They could remove the exclusions. There's some folks that have talked about removing this from the capital gains exclusion but it's a very useful thing, and it's very powerful to be able to give a homeowner that flexibility of capital gains exclusion. So this is an important one to remember in the field when you're practicing as a homeowner, as an investor, and understanding how primary residence and owner occupancy tax exclusions work regarding capital gains taxation. Question number 33. Recording property-related documents in county records serves to protect a buyer by: letter A, recording their liens against the property. Letter B, tracing the title of the property. Letter C, estimating the property taxes on the land. Letter D, all of the above. And the answer, letter B, tracing the title of the property. Being able to follow the history of ownership, the chain of title, for example. Being able to research title to determine if there's any encumbrances on the property that are identifiable. All of these things are tracing the title of the property. So therefore, recording all of these documents inside of public record benefits the buyer because it gives them information or insight into the property so that they can make sure that the title, the history of ownership, and any and all encumbrances are well maintained, represented, and it doesn't compromise their overall rights to the ownership of that asset. Question number 34. Which of the following types of deeds provides the greatest protection to the buyer by guaranteeing that the seller has a clear title and the right to transfer it? Letter A, quitclaim deed. Letter B, bargain and sale deed. Letter C, general warranty deed. Letter D, special warranty deed. And the answer? Letter C, general warranty deed. You definitely want to know the definitions of the different types of deeds. The classic ones are the ones in this particular question. So look up these vocab phrases and make sure you kind of understand them. And learn that the general warranty deed offers the greatest protection to the grantee. It's the safest deed to accept because it's saying, in essence, that anything that comes up in the history of the ownership, including predating my ownership, if I were the grantor, I'm going to protect it for you. So the general warranty deed offers the greatest protection to the grantee. Classic on exams. Question number 35. Which condition does a 1,900 square foot home with 5 bedrooms and only 1 bathroom suffer from? Letter A, incurable physical deterioration. Letter B, curable physical deterioration. Letter C, functional obsolescence. Letter D, economic obsolescence. And the answer is letter C, functional obsolescence. Okay, you definitely want to learn these. You will learn these all inside of your appraisal sections many times in your books that you're studying for these courses. And inside of that, you're going to find out a little bit about the cost approach. And you learn about 3 different types of depreciation. So you want to know that some of these depreciations are curable, some are incurable. You want to know what those definitions are. What is physical deterioration? What is functional obsolescence, which is the answer to this question. So a house with lots of bedrooms and only one bathroom is suffering from this functional issue that it could use more bathrooms. Now, we don't know from anything from the question if you can add a bathroom or not, but if it is cost prohibitive, then it would be incurable. If it is something that we can spend some money and be able to recover the cost, then it's a curable functional obsolescence. So, but the answer here nonetheless is functional obsolescence. The other thing I want you to remember, this is on exams potentially, is that economic obsolescence sometimes also is called external obsolescence. This one is always incurable. That's going to serve you well for this exam. Question number 36. Which of the following best describes the difference between emblements and improvements in real estate? Letter A, emblements are fixtures, improvements are crops. Letter B, emblements are personal property, improvements are permanent additions. Letter C, emblements are structures, improvements are temporary additions. Letter D, emblements add value, improvements do not. And the answer is letter B, emblements are personal property, improvements are permanent additions. Emblements, if you remember, are things like crops that are harvestable. Emblements are those kinds of things, personal property. Remain part of the personal property of the farmer in that old school examples that you see in real estate books many times. Improvements are permanent additions. So a question like this, you want to read carefully, read the answers. There are slight variations, and then there are clearly incorrect statements. And you just want to make sure that you're going through these. You definitely want to know what emblements are, and you want to know what improvements are for your exam. Question number 37. Which of the following best describes the concept of adverse possession in real estate? Letter A, remaining in a property after the expiration of a lease without the owner's consent. Letter B, acquiring property rights through a quitclaim deed. Letter C, gaining ownership of property by occupying it openly, continuously, and without permission for a statutory period. Letter D, receiving property ownership through a probate hearing. And the answer is letter C, gaining ownership of property by occupying it openly, continuously, and without permission for some statutory period. Adverse possession on exams. This is very popular. There's another vocab phrase that goes with this. It's easement by prescription. So prescriptive easement and adverse possession. Every state is going to have different timelines, these statutory periods that are going to be slightly different. So check your states for those as you're learning this stuff. And then go from there. We actually have some flashcards in different states, and then in every single flashcard goes over their adverse possession times, by the way. So you want to know that. You want to kind of know what the definition is. Here's the openly, continuously, and without permission for a certain period of time. Question number 38. An investment property generates $100,000 in annual rental income, with $50,000 in operating expenses and a monthly mortgage payment of $10,000. What is the property's net operating income, or NOI? Letter A, $100,000. Letter B, $60,000. Letter C, $50,000. Letter D, $40,000. And the answer is letter C, $50,000. All right. So this is a really good example of understanding that the mortgage payment is to be excluded and is not an operating expense in terms of determining what is net operating income. Now, again, a student might be thinking, well, hey, it's an expense. It is an expense. It's debt service. We deal with this after. Once we do our initial net operating income analysis and figuring out with, applying a cap rate to what the value is, then we can subtract out the debt service to really drill down what our investment looks like. But the reality is it is a mortgage payment and it is not to be included in the operating expense. By the way, the number one wrong answer here was $40,000. Question number 39. How many square feet are in 1 acre? Letter A, 45,360 square feet. Letter B, 43,560 square feet. Letter C, 43,650 square feet. Letter D, 45,430 square feet. And the answer is letter B, 43,560 square feet in 1 acre. This is a very straightforward, simple one that you're going to need to simply memorize. This is one of those things that you need to memorize for real estate examinations. They used to leave them or post them on the testing centers. They don't do that anymore. You just need to commit it to memory. Not a big deal. You will find this in the legal description sections, specifically for the government survey or rectangular survey system. Question number 40. What type of lien would allow the IRS to place a claim on all assets of a person who owes back taxes? Letter A, mechanics lien. Letter B, specific lien. Letter C, general lien. Letter D, judgment lien. And the answer is letter C, general lien. Okay, so the IRS has the right to place a general lien, which goes to and places on all properties that we have versus specific properties, which a mortgage is a type of specific lien. A general lien is a lien that applies to all of our assets, and the IRS would have the ability to place a lien on all assets if back taxes are owed. Question number 41. Which of the following is not typically included in the bundle of rights associated with property ownership? Letter A, the right of exclusion. Letter B, the right to control. Letter C, the right of rescission. Letter D, the right of enjoyment. And the answer is letter C, the right of rescission. All right, so the bundle of legal rights you'll find typically in real property law sections and real estate books. It covers those sort of like so many times it's listed as 5 different elements: the right of exclusion, the right of control, the right of position, the right of possession. So you want to know these different bundle of rights and understand them. The right of enjoyment. These are all going to be potentially on there. And the question many times is going to be something like this, where they might say all of the following are or not, those types of questions. So the bundle of rights, check it out. Question number 42. Which legal description method uses physical features, distances, and compass directions to describe a property's boundaries? Letter A, lot and block. Letter B, meets and bounds. Letter C, rectangular survey. Letter D, township and range. And the answer is letter B, meets and bounds. So the meets and bounds description is one of 3 legal descriptions that you're going to learn about in these courses. You'll learn about the meets and bounds, you'll learn about the lots and blocks, and you'll learn about the government or rectangular survey system. And the meets and bounds system is a system that uses the property's physical features. Remember, it always starts at a point of beginning, and the point of beginning equals the point of end. And it uses these fixed features on the property known as monuments in order for us to describe the property legally. It's the oldest method of legal description that exists in the United States. Question number 43. A property owner allows a neighboring property owner to cross their land to access a main road. What type of encumbrance does this create? Letter A, a lien. Letter B, an easement. Letter C, a deed restriction. Letter D, an ordinance. And the answer is letter B, an easement. So this is a type of easement, and many times they might call this an appurtenant easement. Sometimes they might call it an easement out of necessity, right? So these could be the different subcategories of easements. So you want to know what an easement is, and you also want to understand dominant tenements, servient tenements, different types of easements, like an appurtenant easement, an easement in gross, a prescriptive easement, which combines with adverse possession. So you want to know these different ones. This is definitely an easy one to see. It's a classic style of question for exams. Question number 44. An agent signs an exclusive buyer's agreement with a home buyer. After 6 months of searching, the agreement expires and the buyer starts working with a new agent. What fiduciary duty does the original agent still owe the buyer? Letter A, loyalty. Letter B, confidentiality. Letter C, reasonable care. Letter D, none, because the agreement has ended. And the answer is letter B, confidentiality. Okay, so many times with fiduciary duties, remember, you can remember them through old car or cold AC, you can pick. Care, obedience, loyalty, disclosure, accounting, and confidentiality. Now, one thing that many times students don't know, or sometimes teachers don't cover this, is that confidentiality must be maintained forever in many states. So, with this particular question, you want to remember, generally speaking, that any fiduciary duties that must continue even past the expiration of a listing, it's typically going to be confidentiality. Question number 45. Which protected class was added to the Fair Housing Act by an amendment in 1988? Letter A, religion. Letter B, familial status. Letter C, national origin. Letter D, race. And the answer is letter B, familial status. So the protected classes added to the Federal Fair Housing Act, or that the Federal Fair Housing Act created, are definitely things we need to memorize. Remember, for the federal level Fair Housing Act, there are 7 protected classes: race, color, religion, national origin, sex, familial status, and disability. Familial status and disability were added in the 1988 amendments. That is classic. You want to know that. Now, the Civil Rights Act of 1866, that's one date you want to remember, and that was race. Then you want to remember 1968, which was when the Fair Housing Act was written and passed. That was 1968, and there was those original protected classes, and then the 2 added ones later were going to be the familial status and disability. So you want to know that for sure for questions on this examination. Question number 46. Which of the following could terminate a real estate purchase agreement? Letter A, the buyer defaults on the agreement terms. Letter B, the buyer finds a property that they prefer. Letter C, the buyer feels the price is too high. Letter D, the seller asks for an extension. And the answer is letter A, the buyer defaults on the agreement. So the question is asking us which of the following could terminate a real estate purchase agreement. And a buyer defaulting on their agreement terms, likely could terminate this contract. If the buyer finds a property they prefer, may not terminate what is binding this buyer to this contract. A buyer feeling that the price is too high is not necessarily a reason that the contract would terminate, and the seller asking for an extension is really not so much grounds to terminate the contract. I mean, obviously, if there was time to perform, there could be stuff. Don't read too far into questions like this and try to overanalyze them. Letter A was clearly the best choice amongst the other 3. Question number 47. Which of the following is a primary purpose of title insurance in a real estate transaction? Letter A, to guarantee the value of the property. Letter B, to protect against future zoning changes. Letter C, to cover financial losses from defects in title discovered after closing. Letter D, to insure the property against natural disasters. And the answer is letter C, to cover financial losses from defects in title discovered after closing. So you want to know the basic definition of title insurance. You want to know what an extended policy is, what a standard policy is, what the phrase alta is, what a preliminary title report is, what an abstract of title is, what a chain of title is. All of these are title phrases. Again, you'll see these in the title section or the deed section of your books, so check them out. So you definitely want to know that, and you want to know the basic or the primary purpose of what title insurance is, and it's to cover financial losses from defects in title discovered after closing. Question number 48. Which of the following best describes a mortgage loan with a balloon payment? Letter A, a loan with fully amortized payments that end with a zero balance. Letter B, a loan with an interest rate that changes based on market rates. Letter C, a loan that has smaller periodic payments and a large final payment at the end of the term. Letter D, a loan that requires no down payment. And the answer is letter C, a loan that has smaller periodic payments and a large final payment at the end of the term. So this is just a classic definition of what a balloon payment is, what a mortgage with a balloon feature is. And you just want to know that it's a partially amortizing loan, pretty classic on exams. You want to know a little bit about what full amortization is, what partial amortization is, and sometimes even what negative amortization is. Question number 49. A tenant signs a lease that requires them to pay rent plus certain property expenses like taxes and maintenance. What type of lease is this? Letter A, gross lease. Letter B, net lease. Letter C, percentage lease. Letter D, sublease. And the answer is letter B, net lease. So you want to know some of the basic types of leases and their definitions. This is a classic definition of what a net lease is, where we're paying rent plus certain property expenses like taxes and maintenance. Now, if we're paying all of the expenses in addition to a base rent, then they call that many times a triple net lease. And then you want to know the basic definition of a gross lease, which is very common in residential transactions, and a percentage lease you'll see in commercial or retail transactions. And a sublease is basically a lease inside of a lease, sometimes also known as subletting. Question number 50. In a real estate transaction, which document itemizes all credits, charges, and the final costs due at closing? Letter A, the appraisal report. Letter B, the purchase agreement. Letter C, the closing disclosure. Letter D, the deed. And the answer is letter C, the closing disclosure. So again, the closing disclosure, sometimes referred to as the CD, is the sort of the final itemization of all credits and charges and final costs due at closing. Remember, this closing disclosure is due 3 days from the settlement, and the loan estimate is the other document on the front side if you're borrowing money from a bank that the lender has to give to you within 3 days. So there's a loan estimate, and then there's this closing disclosure, or the final numbers will be represented on the CD, or the closing disclosure. All right, there was 25 more questions for you. Hope the studying's going well. Remember, the goal is to get you through that real estate examination for 2025. It is an absolute privilege to be with you, to be working with you on this stuff. Study hard, study well. Please smash that like and subscribe button. Tell some friends if they're studying also. We'd love to help them. Hopefully you're finding some value in this. Good luck, and we'll see you in part 3.